Okay, we go.
Okay. Hello, everyone. Thank you for joining me this evening. I'm delighted to be invited back by Pepperstone to present this information and webinar to you. I've got a pretty jam-packed session filled with what I hope you will find to be useful information. And a lot of this comes from my experience as a bank dealer and also working with a lot of fund managers who have developed various trading systems through the years. Before I get too much into it, though, I do want to share with you this disclaimer that basically explains that trading forex carries a high level of risk and may not be suitable for all investors. Past performance is not indicative of future results. So if you're watching this on demand, please make sure you read through this disclaimer thoroughly. It does explain that trading forex is something that you need to fully understand the risk before starting this endeavor. So the question that we want to start with asking today, are hedge funds and bank traders really smarter than the rest of us? Well, they certainly receive a higher paycheck than we do for trading forex, because they basically are allowed anything more than $1 is a higher paycheck, because all of us have to earn every pip that we make, whereas all of these hedge funds and bank dealers have a salary in addition to profit sharing on whatever return they make for their customers. But I think it's important to understand what they do, and basically try to use that information um, to see if it's something that we could replicate as well. So I started off saying that a lot of this comes from my experience trading at hedge funds and bank dealers. I actually started my career on a desk that looks pretty much exactly like this. I started trading forex in 1999 at JP Morgan Chase. I wouldn't be surprised if some of these were actually my coworkers sitting here with their Bloomberg terminals and squawk boxes. If you look very, very closely onto what's on their desks. But I started my career at JP Morgan Chase, actually on the interbank trading desk. What that means is we basically made markets in the euro, dollar yen. At that time, the euro was just launched, so I was actually responsible for quoting some of the, if we providing quotes on some of the legacy currencies that were previously not a part of the euro, but now a part of the euro, and trying to give them the appropriate quote for that. I also made markets in dollar yen on their e-platform, which at that time, I was a very new dealer, just straight out of college, and they gave me the responsibility of the e-platform, which is their online trading platform, because no one traded on it at that time. Everyone traded on, through calling the desk and through the more experienced dealers. But now we know, the majority of trading is done on an e-platform. So I was there from the very beginning. But anyway, I digress. So I had a lot of experience understanding how these traders trade, and they actually traded very, very differently at JP Morgan than at JP Morgan Chase, the combined company. JP Morgan was very much, the kind of boys club, white collar type of firm, where um, at the time, basically whenever there were profits, it was kind of spread across the desk, and the salespeople would sit. If you look at this image right here, the salespeople would sit on one side of the desk, and the dealers would sit on the other side of the desk. So when a client would call in, they would basically call into the salesperson. The salesperson would stand up, ask for a quote to buy, let's say, 10 million euros, 10 million euro dollars. And sometimes at these banks, because the salesperson would know their customers so well, they they may know in advance whether or not this customer is willing to pay up for for buying euros, or if they're actually leaning towards buying euros or selling euros. So they may point up to the sky, indicating to the dealer that this person wants to buy. So maybe you want to spread them a little higher on the top, which you may think, oh, this is completely illegal, but you may not know that while the retail forex space is extremely, extremely regulated by regulators all around the world, the interbank desk and the bank dealing space is still very much, or at least at that time, the wild, wild west. So they understood their customers. They could signal to their dealers that they would quote higher, and they would just spread the love all around in terms of, if they made profits on the trade, they may give a little bit back to the salesperson, and the dealer would spread to the person to their left or their right. At Chase, on the other hand, Chase, it was a much more aggressive firm, and everyone had their own what we call blotter, where they would manage their own P&L, and there would be small dollar yen traders, large dollar yen traders, not in terms of height or anything like that, but in terms of size they were given, where one dealer may be given responsibility for quoting on 0 to 10 million, another dealer would be given the responsibility of quoting on 10 million and up, for example. And so they would manage very different size books based upon how experienced they are, but they will all sit in a very similar scenario, which is salespeople on one side of the desk, dealers on the other side. Chase was a larger company, and it was much more competitive, so they didn't necessarily share information as much. So the quotes were much tighter, they were much more aggressive in the FX space. But what I really want to impress on you is the structure of the desk. You notice that everyone is sitting next to each other. So if this man in the tan shirt, which is, there's only one man in the tan shirt in this picture, is the Eurodollar dealer, although he looks like he's eating his ramen right now. But if he's the Eurodollar dealer, then the salesperson may stand up and ask for a quote on the Eurodollar and say, okay, my client wants to buy 20 million euros. The person to his right, the guy in the checkered red shirt, may hear, wow, that's a really big Eurodollar size. Let me just jump right in and buy a little bit for myself. And actually, there's another row that you don't see of those chairs behind him, which is the chairs I moved to when I moved within JP Morgan to Chase, and that was the proprietary, the prop desk, basically the FX prop desk, who sat very close to dealers, can also hear in on this flow and say, wow, this trader's coming in, or this client's coming in and buying 100 million euros. There's going to be a little bit of continuation on this, or at least the dealer will have to work that flow. So let me jump in a little bit and get into that trade. So the structure of the desk facilitates the dealers kind of or the traders understanding where the demand is, and maybe leveraging on that demand. Now you may sit and think, oh my gosh, this is so illegal. But once again, the interbank space was a wild, or is still in many ways a wild, wild west. And of course, internally, they want to facilitate an understanding of where the demand is. But that was very much what the bank traders did all day. They do not trade like some of us do. Some of you may be what we like to call swing traders. And what swing traders do is they basically go for 40, 50, 100 pips. Most of these bank traders were much more short-term traders. They traded for the next 1 to 2 to 5 pips as opposed to the big moves, because you have to think about it. They're swinging around millions and millions of dollars unlevered. Well, of course they're using the bank's balance sheet, but they're swinging around a minimum of $5 million on each trade. So even if they went for a couple pips here or there, this was very significant on a P&L basis. So I think this is very important to realize, because for the most part they trade very differently from us. Now, of course, bank dealers trade different from hedge funds, and there are many different categories of hedge funds. Most hedge funds these days are one of the top 3 listed on this list, and we have fewer hedge funds that are what we call the global macro hedge funds. And even if we have global macro hedge funds, usually it's a smaller portion of their portfolio than 1, 2, and 3. So how do these hedge funds and bank traders trade? Well, the majority of them trade short-term flow and momentum, and I'll get into each of these in more detail as we progress. But most of them trade short-term flow and momentum, or they trade event-driven, which is a little riskier, but if they feel the confidence in their views, they may trade event-driven. Many hedge funds. So bank dealers mostly trade short-term flow and momentum, and some of them may trade event-driven. Hedge funds trade event-driven. Some fewer hedge funds trade short-term flow momentum, but many hedge funds trade what we call mean reversion market neutral strategies, which sounds really fancy, but I promise you it's going to be much easier to understand once we get into the nitty-gritty of it. And fewer hedge funds trade what we call global macro. So let's start with short-term flow and momentum. Why does it work and what is it? Well, short-term flow and momentum works because you're trading on a very short-term basis. And usually when you're trading on a short-term basis, when there's a breakout or a big news or a trigger or a acceleration of a movement, there oftentimes will be a momentum as the shorts cover their trades and the longs join in the trade, and as people get surprised, they end up being late buyers and so forth. So it works for short-term movements. And if you've attended any of Boris's sessions, you'll know that they don't always continue, for very long, but they can last for, 2, 3, 4, 5, maybe even 10 pips max, in my opinion. So more specifically, what are these bank dealers and hedge fund traders do? Well, one, they're trading institutional client flow. I mean, they're listening to what their neighbors are getting in terms of orders. They may be jumping in. They're trading for the next pip by trading this institutional client flow, where they're basically hearing that someone wants to buy 100 million euros, and they may just join in for the next pip. Or they may trade, for example, we know that oftentimes Eurodollar or many currencies like to gravitate to the round numbers, the big figures, like 113, 114. Dollar CAD, loves to gravitate to the round numbers. You saw how quickly when it dropped yesterday from 129 down to 120, 850 down to 127. It loves to gravitate to the 50 and the 100s. So oftentimes these people may trade and run for the OO, the next pip, or just running for the round number or close to it. Or they may trade new highs, new lows. Oftentimes currencies like to make new highs, new lows, and when they do that, it may continue for a little bit more. So, oftentimes they'll do that, and they'll just go for these short-term trades, in that direction. Now, it is very hard for you and I to replicate many of these things. Institutional client flow, impossible to do because, you and I are all, trading at, on our own computers, more or less in a vacuum unless, we're trading together, but certainly not with the benefit of seeing what, big players are doing. So we can't do that at all. And that's where the bank dealers really have a leg up on that, on us. Trading for the next pip, we can do. And I think that Boris has shared many strategies with you. If not, please let me know. But I think he shared many strategies with you to trade for the next pip. And then recently I shared a strategy which trading new highs, new lows with you, just, running for the new highs and new lows. But there is one momentum strategy that is near and dear to my heart that I've traded for a very long time that is also trading that kind of fuses the psychology of short-term flow and momentum with the or short-term trading with the momentum strategies or techniques that some of these bank dealers use, and it is what I like to call the Momo trade. The Momo is a momentum trading strategy, and I like to use this on 5-minute charts, and is best used, in my opinion, for day trading. So the strategy uses a couple of things. First and foremost, the strategy uses the SMA and the MACD, and the SMA is the 20-period simple moving average, and the MACD settings are basically the standard MACD settings that you put on any charts. And the rules are fairly simple. The first rule is you want to look for a currency pair to move from below, for a long trade, below the 20-period moving average to above the 20-period moving average. So what that tells us is that when it does that in a 5-minute chart, it tells us that we're beginning to see a change in trends. But just because it does that does not mean that it's time to take a trade. Because when it does that, you want to check to make sure the MACD has moved into positive territory within the last 5 bars. And the reason why this is significant is because you want to make sure that you're trading a new change in momentum, not a change that has happened an hour ago, for example, because at the time you're not trading a new momentum. You're trading, momentum that may have been in place for some time. So you want to check if MACD's moved into positive territory within the last 5 bars. And still, that is not, you don't take a trade yet. But just illustrate this visually. The blue line is my 20-period moving average, and the MACD is the bottom. I've actually, when you put MACDs in charts, you also get some additional, the signal lines. Just for cleanliness on my chart, I've kind of shaded them white, so you can see the histogram a little bit more clearly. But if it's on your charts, no big deal. You can just leave it there as well. So as you can see here, basically you've got the currency pair moving above the blue line, which is the 20 moving average. And when you look down, you'll see that that if you kind of look closely and count the bars, we're within the last 5 bars. And this is a very recent chart of the pound dollar, just from this past week. And you would only want to go along when the currency pair moves above the moving average by 10 pips. Why is this important? Because there are many times where the currency will weave in and out or peak above or below the moving average. And so you don't want a false signal. You want to filter. And we basically use the moving average as a filter for our trade. So you go long 10 pips above the 20-period moving average. So you buy at 28.76. The moving average is basically at 128.66. So when you wait for it to move 10 pips above the moving average, that's when you buy. You set your stop. These are short-term trades. You set your stop for 20 pips. And so your stop is 128.56. And so your stop is actually pretty much where my arrow is, the top of my arrow. So you can see visually on the chart that at no point does it go down there. And remember how I told you with short-term trades, generally speaking, 10 pips is I wouldn't say all you get, but oftentimes is the maximum of what you get for a quote-unquote momentum flow trade. And you've probably seen a lot of that with Boris's trading strategies, which with short-term trading, you can't go for a lot of pips. And oftentimes with short-term trading, you have to go for negative risk reward, because in order to maintain what we focus on, which is a high percentage hit rate ratio, which is a high percent of winners, to kind of quote unquote cover those losers. So you basically put a 20 pip stop, 10 pips target, and if you're trading multiple positions and you want to continue to potentially ride the trade for more, which sometimes we get these momentum moves, it can be quite significant. You can move your stop to break even, and then trail your stop using the moving average on the remainder of the position. So how would this have worked? So in this trade, the way this would have worked is you basically would have gone long at 128.76, stop at 128.56. Our target's 128.86. So our target gets hit 15 minutes, maybe a little bit longer, maybe 20 minutes, because the high here was 86 on the other candle. But about 20 minutes after you put on the trade. Now, the very high of this chart is 128.92. So you pretty much would have just gotten your 10 pips, and if you move your stop on your remainder of your position to break even, your initial entry price of 128.76, your second position would have closed at break even. So you could, I mean, sometimes these moves do become much more prolonged, and you may see that in some other examples that we look on the charts. But if you just want to go in and out, then 10 pips in, and then move on to the next trade. Here's another example on a short trade. So the short trade, the rules are completely reversed. And don't worry about, kind of scribbling down these rules. I'm sure Pepperstone will share with you this recording, and you'll have the rules at your disposal. So you want to look for a currency pair to move from above the 20-period moving average to below the 20-period moving average. When it does that, you want to check to make sure MACD has moved into negative territory within the last 5 bars. So you can see here that the currency pair in this example here has broken below the moving average, and that pretty much happens, looks like at 114.01. Now you may think, okay, on the left-hand side, it looks like it's weaved in and out of the moving average as well, but in those examples there, it was actually less than 10 pips. So we see that it's moved below the moving average, you go down, you check to make sure that the histogram has turned negative within the last 5 bars, and it has. So you go short 10 pips below the moving average. We sell at 113.96. Our stop is 20 pips above at 114.06. So our stop, once again, is pretty much where the top of my arrow is. And our target is, again, 113.86 for the first half of the position. And then you can move your stop to break even if you want, and trail using the moving average on the remainder of the position, or you can just go 1 in, 1 out, 1 in, 1 out, which is what I prefer to do. The only time it really works for trailing is right after a big economic release, because that's when you truly have continuation. Because right after economic release, you have a much greater chance of additional movements than just kind of when nothing's really happening. So here, you basically go short at 113.96. Your target is 113.86, and we basically close our position at 113.86. So summary is that this is a momentum trading strategy, 5-minute charts, and it's best for day trading. So we talked about how one way that hedge fund traders trade is basically to trade short-term flow and momentum. And this is one of the 4 ways. The second way is to basically trade off of round number reversals. So I don't know if Boris has shared with you a strategy, but it's pretty simple. The second way is in short-term momentum and flow is basically to trade for the next pip, or to fade some of these new highs, new lows. So one way you could do that is to trade round number reversals, because what I want to illustrate to you is that round numbers are very significant, and so oftentimes when a currency runs to a round number, it will retrace before it continues on. And that's why if Boris ever showed some of his kind of boomer strategies, or I'm not sure exactly what he has shared with you, he basically fades the break of a round number just slightly above it. Now this works better for certain currency pairs, like it works better for dollar yen and the euro dollar, and doesn't work so well for some of the trending currency pairs. But what you want to sell and where you want to fade the round number is actually not exactly at the round number, because oftentimes it'll make a run to that round number and get a little bit above it. So if the currency has not gone to the round number in a very long time, meaning that we hadn't seen dollar yen hit 112 in a couple of weeks, then this becomes a much more significant level. So a great place to sell would be slightly above the round number, like basically I would say 4 or 5 pips is perfect. So basically you want to sell 4 to 5 pips above the round number, 112, 04, for example, with a 20 to 25 pip stop. Oftentimes 20 is sufficient for a pair like dollar yen. For a trending pair like pound dollar, maybe 25 pips, maybe more significant. So, dollar yen runs up to 112. We sell 112.04, 20, let's say 20 pip stop at 112.24. The high here is, and then basically want a 10 pip target. And sometimes we'll go more because in this case, it stopped right at 112.07 and then dropped all the way down to 111.50. But we don't want to get greedy because sometimes, the continuation can be much more significant. So next time it makes a run for 113, but it doesn't quite get there. So no big deal. We wait. We're patient. So it goes up here. This candle is 113.07. And in this case, it only retraces about 20 pips. And it doesn't retrace the 50 pips. So our 10 pip target is reached. And then next we wait for 114, so it goes up to 114. And it actually continues a little bit more. If you sell 114.04, our stop is at 114.24. And it goes as high as 114.18, but it then does retrace. And it retraces to about 113.75 down here, or 78, I believe, which is more than sufficient for us to get our 10 pips. Here's another example. So as I said, this doesn't work as well as the big trending currency pairs like pound dollar, and you'll need to use wider stops. But it works really nicely on dollar yen, and it works really nicely on Aussie dollar and Kiwi dollar, for example. So Aussie dollar here, 75, it makes a run for 75 cents. We hadn't seen 75 cents in a long time. 75 cents, obviously a very big round number. So you sell 75.04, stop 20 pips above 75.24. It gets as high as 75.17, reverses lower, and actually drops 50 pips. So you could use the T1, T2 method here, where you close half your position when it moves to plus 10, and then trail your stop to see if you get more. So then it drops down to 74, and perhaps you want to fade the 74 cents. So it comes down to 74, and you basically buy 73.95, and you have a stop 20 pips below at 73.75, and the low on this move is 73.80 before it reverses higher. Here's another strategy in Kiwi dollar. So with Kiwi dollar, we hadn't been to 73 cents in a while, so you're looking to sell 73.04, stop at 24, its high is 19 before it completely reverses. So this is how you could trade, quote unquote, for the next pip using some of this fading new highs, new lows, but we're applying this to round number thesis that bank traders do. So the second way to trade is event-driven. Why does this work? Because when you trade event-driven, the idea is that when big events occur, there tends to be continuation. And this is harder for most people to do because it's harder to chase news movements because we never know whether it's going to continue or not. But sometimes when it's significant, like in this case, we have what we call the Macron gap. Some of you might remember when Emmanuel Macron won the French presidency, euro gapped higher, and it was a move that just continued on and on and on. So this is what some of these bank dealers would do on a swing basis, and we could. We write about this all the time in our weekly report. Boris shares his weekly technicals. You can use some of those ideas to help you get into some of these swing trades. On a short-term basis, you could also trade some of these event-driven events, basically, by riding the momentum that may happen after a big news, like not the most recent non-farm payrolls report. Dollar yen initially pulled back, but we actually live trade the non-farm payrolls report with our members, and at the time I talked about how even though wage growth slowed, and the unemployment rate increased, the number was good enough. And it was good enough for for people to believe that Yellen was going to walk into the event optimistic and maintain our hawkishness. So we actually had our members, buying in the direction of a stronger dollar yen after the non-farm payrolls report, and you can see that the mood rose quite a bit. And yesterday we actually live traded the Bank of Canada rate decision with our members, and made about 50 pips. And in very short-term trading as we ride the momentum of these big events. It's very difficult to do in a vacuum by yourself, but if you participate in our live trading events, you'll learn how to do so with us. Or quite simply, the Bank of Canada was very positive, and you saw the dollar CAD was crashing. And I previously told you that dollar CAD loves to gravitate to the 50 and the figures. So every time it would break the 50 of the figures, you could just basically ride the continuation moves. So the third strategy that these bank dealers or hedge fund traders do are what we call market neutral mean reversion strategies. And really fancy name for basically what I like to call getting back to average. What I like to call, if things get really overextended, these dealers basically, quote unquote, bet on things coming back to the average, to the norm. So I have one strategy that can hopefully help you do that. And that strategy is called the extreme fade strategy. An extreme fade is a mean reversion strategy using 15-minute charts. So the strategy uses Bollinger Bands, which I showed you in one of our last sessions, and ADX. Now, with our longer term trading, we use 20 period 2 standard deviation and 20 period 1 standard deviation. For short term trading, we have to use more exaggerated levels. So we're looking at the 20 period 2 standard deviation and the 20 period 3 standard deviation. And the ADX is set at 14. So the rules are simple. First, for a short trade, you want to look for the currency pair to rally, 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 and then close at or above the 3rd standard deviation, indicating that this is an extreme move. So here, well, I'll show you the chart next. And then after that happens, you want to wait for the close below the 2nd standard deviation. So here you can see dollar yen rallying, 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 closing or at the 3rd standard deviation Bollinger Band. When it closes at the 3rd standard deviation Bollinger Band, you wait. The first thing you want to do is you want to make sure that the ADX is above 25, meaning that it's trending. And then you wait for it to close below the 2nd standard deviation Bollinger Band. So I didn't mention this. The outside lines, the outside Bollinger Bands, are the 3rd standard deviation, which is the really exaggerated move, the really overbought, oversold level. The inside lines are the 2nd standard deviation. So if it rolls over and closes below the 2nd standard deviation Bollinger Band, it indicates to you that that rather than arbitrarily picking a top, you're waiting for some type of exhaustion, and then you're joining into the move when there's a little bit of a top in place. So here you're waiting for it to drop below the 1st standard deviation Bollinger Band, and at the time check to see if ADX is, this should say greater than 25, because you want to make sure that the trend is strong. I can't change it here, but you basically see that, and you sell at 113.74. Stop, 20 pips stop again. Stop 113.94. Same thing, 10 pip target, move stop to break even, trail your stop on the remainder of the position. So in this case, we sold 113.74, stop at 113.94, never even gets there because 113.94 is pretty much where the top of these upper arrows are. Then it retraces and we close for 10 pips, 113.64. You can see that's all we get. Sometimes we get more, but oftentimes with these short-term trades, you got to be nimble, you got to be fast, and you got to grab your pips when you have them. So we could target 113.64 and we exit the trade. Here's another example. We see dollar CAD crashing and it closed below the third standard deviation Bollinger Band, and then it continues a little bit more. Then we wait for it to close above it, and we go long at 129, and we get our 10 pips here. Here's another example. This one actually continues a bit more, but we're not going to be greedy. We see that the euro dollar, the earlier part of the chart, closed below this third standard deviation Bollinger Band. We wait for it to close back above the second standard deviation Bollinger Band, the inner lines. That gives us the signal, and we basically go long and ride the move higher. And then lastly, the last technique that hedge funds traders use is the global macro trade. And when we say global macro trade, we're talking about the big ideas, basically trading things like interest rates. And this is a 6-month chart, long-term chart of dollar yen. And the orange line is the 2-year yield spread. So basically the 2-year US yield spread minus the 2-year Japanese yield spread. And the white line is dollar yen. And you'll see that that these are pretty much mirror images of each other, where oftentimes the orange line which is the yield spread, will lead the white line. And this is very much the case where dollar yen takes its cue from US yield. So these global macro hedge funds may have an opinion about where U.S. interest rates, where U.S. yields are headed, and they may take these long-term trades in the direction of where they think these interest rates are headed. So in this example, which is actually a really good example, I just snapshot this at the beginning of the week before I submitted it to Pepperstone for review, and you can see the orange line was already dipping lower, telling us that maybe dollar yen's going to fall. And look at where it is right now today. It's trading at 113. We obviously had a big event risk with Yellen, but this orange line was very telling, and this is what these traders trade, which is these big moves in FX. And another example here, this is they also trade the correlations between commodities and currencies. And the orange line in this case is the Aussie dollar, and the white line is the iron ore. And you all know how important iron ore is for the Aussie dollar. And you can also notice there's a very strong kind of correlation between iron ore and the Aussie dollar, as you can see from this chart. And iron ore recently has been pointing up. Aussie dollar is kind of figuring out where it wants to go, but now it's trading much higher. So iron ore has also been a good leading indicator, because if you look very closely, the white line actually precedes the orange line a little bit, and can be as a guide to where these things are headed. But with global macro trades, when you swing big, you can lose big. One of the most famous global macro traders is someone named John Paulson. He shorted the subprime, made $3.7 billion in 2007, beat hedge funds and made $5 billion in 2010. But in 2011, the value of the fund dropped 40% when he bought Bank of America and Citigroup. So when you swing big, you can lose big. And the same thing's true. The biggest trading loss ever, Morgan Stanley, was in 2008, $9 billion. So I all remember the London whale, who made you may or may not remember the London whale, who made a $2.3 billion bad debt. Howie Mandel, who bet on the rising housing market and lost big. And long-term capital, when all these PhD, Nobel Prize-winning economists got it wrong, and when genius failed. So trade big, you lose big, and one consistent quote-unquote theme of all these dealers is that they basically didn't use stops. And hold on, let me just write this one down. Okay, they basically didn't use stops. I mean, no stops, you have the risk of total loss. So that's why it may be in many ways better for us to focus on day trading. And because it's much more controllable, it's basically it allows us to keep our stops and focus on the short-term movements rather than, exposing ourselves and hoping that that if we swing for the fences, we will make it big. So of all the hedge funds and bank dealing strategies that I talked about, some of them we can apply to our own trading, some of them we can't. We know that we have no ability to trade institutional client flow because, we don't sit at these desks, but a lot of the theories and theses that these guys use, we could apply to our own trading. So what can we do? We can trade short term. We can trade high probability. We can trade themes. We can trade event risk, although, the last part may be a little bit more difficult. When it comes to developing trading strategies, there's also some lessons that we can take, and lessons that I've learned while working with these hedge funds. When I worked with these hedge funds, I realized that they have a very methodical way of thinking, and that should make a lot of sense to you because these guys are trading a significant amount of capital. And they need to have accountability. They need to prove to someone, maybe their risk management desk, that the ideas that they're using are legitimate ideas that could, that basically they're legitimate ideas that have some sort of back testing and can be replicated time after time. So in order to do that, they have a very methodical process when they come up with these trading strategies. And this is basically the 6 steps to strategy development. And I learned these 6 steps from, the biggest hedge funds on Wall Street. And I thought, if these guys are using this methodical way of thinking to basically to create their strategies and manage their trades, maybe we should do so as well. Because while they may be swinging for the fences, and while they may be doing this because they're trading millions, maybe even billions of dollars, at the end of the day, what we're doing, I feel, is much more important. Because what we're doing is we're trading our own money, and these guys are trading somebody else's money. So even if we're only trading $10,000, that $10,000 is so much more important to us than it is than the $1 million they're swinging around, because that's someone else's money that they're trading. We're trading our own money. They're trading someone else's money. So what do you think is more important? Obviously, our own money is more important than them trading someone else's money. In my opinion, you may disagree, but I think my hard-earned money is much more important than if I'm trading, swinging around someone's millions of dollars. So that's why I think that applying these 6 key steps is so essential, and you're trying to think like a hedge fund trader is so essential. So what are these steps? The first one is, before they even start trading, they define a strategy. They think about, what am I trading and how am I trading it? They're not just going in trading blindly. They devise money management rules, and then they test. They understand performance, they understand drawdown, and they look for room for improvement. So let's unpack this. The first one is define a strategy. It may seem simple enough, but there's a lot of questions that you have to ask yourself. What am I trading? Am I trading based upon fundamentals, news releases, or am I trading based upon technicals, like an indicator? Am I trading a range, buying low, selling high? Am I trading trends or breakouts? Am I trading long-term, medium-term, or short-term? If I'm trading short-term, my stops should be much tighter. If I'm trading long-term, my stops should be much wider. But you want to make sure I understand this, because you don't want your short-term trade to become a long-term trade, because you're only doing that at that point out of desperation. But their thinking goes a little bit, extends more than that. They'll think about, what currencies are they trading? Are they trading majors or crosses? What time frames are they trading? Are they trading 15-minute charts, hourly charts, or daily charts? Because the strategies and techniques that you use and the stops and the targets that you use for 15-minute charts are very different from the ones that you use on daily charts. And also, a 20 pip stop may be very significant for your Aussie dollar trade, but could just be a blink of an eye for your Euro Aussie or your pound yen trades. So you want to make sure that you're using the right stops and targets for the right time frames that you're trading. Then you have to ask yourself, will I hold these positions overnight when I'm not watching my screens? And will I hold my positions over the weekend? These are all questions that they ask themselves before they place their very first trade. And I think you need to think about when you're looking at your trading strategies. Money management. Multiple entries or multiple exits. Am I just buying all at one price and then exiting all at one price, or am I scaling in, scaling out? Oftentimes you may do that when you're in the trade already, and at that time is the worst time to do it, because you may just be, we always like to say, only losers buy into losers, and so that's why it may not be the best way. You may not be the most rational when you're in a trade, and what you're doing may be just responding to your P&L rather than responding to your strategy. So it is always most useful to think about this before you have a trade on. So if you are thinking about buying low and selling high, you may want to ask yourself, how low am I willing to buy? How far down do I want to buy? And basically, how low do I want this to move against me? So you want to make sure you establish and you think about all these things before you put your trade on. What are the risk to reward parameters? You definitely want to have your stops on. When do you want to take profits, trail your stops, close your positions? Seems like a lot, but it's really important to think through all of these things. And these hedge funds, because they have so much money at risk, will always think through all of these things before they put on their very first trade. Then when they develop their trading strategy, they always test. Everything needs to be tested. If you're savvy and you know how to code, then you can maybe back test in MT4 or in easy language. But at bare minimum, even if you don't know how to do these things, you want to review the charts. You want to look for at least 15 to 20 examples of what happened, and you want to make sure that you can see positive results before you actually take a look at the trades. Because if you're looking back in your charts and you can't find any examples of this working, then maybe you don't want to take the trade. And that's even true of any strategy you learn from us. Then you want to look at more granular time frames, and you want to demo trade to see basically what are the best ways to look at this. What are the different ways that you can evaluate what are the different ways that you can evaluate your trading strategies. And once you demo trade, you want to make sure you can make money on demo trading before you actually live trade. So after you're trading for a while, you get to understand your performance. What are the percent of winners that you can expect? What is the profit factor? Is it a strategy that's supposed to win 80% of the time? Or are you only supposed to win 30 or 40% of the time, and as you wait for your big winner? Because if you're supposed to win 70, 80% of the time, but you find that you're only winning 20, 30% of the time, then perhaps you're in the wrong trade. Understand drawdown. What is the biggest drawdown that you can expect from this? Is it on a closing basis or is it on an intraday basis? All things to think about. And all of these things are things that hedge funds think about before they even put on their very first trade. And most importantly, it's important to understand leverage, because it is very difficult to recover from some of your trades if you trade with too much leverage. So let's imagine if you're trading with no leverage and you have 5 consecutive losers, 1% losers. If you are trading, and sometimes we are unlucky and we get into these stretches, and we may have 5 consecutive 1% losers. If you're trading with no leverage and your accounts drop from 10,000 with 5 consecutive losers, it's only dropped to 9,500, and you only need to make a 5% return to get back to break even. And I think many of you will say, okay, I think this is achievable. I think I can make a 5%. I think I can make, or most of you will feel confident that you could make 5% just to get yourself back to even. But if you have 5 consecutive losers on even 10 to 1 leverage, which is a more conservative leverage, Then your account drops from 10,000 to 5,900. And in order just to get back to even, you have to make a 70% return, which is much more difficult. And at that point, you may be taking a bit more risk than you should be taking just to get yourself back to even. And to really hone this in, if you lose 90% of your account, or if you lose 25% of your account, you need 33% return to get back to even. If you lose 50% of your account, you need 100% return. And if it's so terrible that you lose 90% of your account, at that point, you're really doing something very reckless in order to get back to even and make a return of 1,000%. So finally, the last step is improvement. With any trading strategy, once you've traded it for a while, you want to, evaluate it. Every couple of weeks, I always look at my trading strategy, see what works, what doesn't work. When are the losing trades? When are they usually done? Should I be avoiding news? Should I be limiting my trading to a specific time of the day, or am I cutting losses early? Sometimes I may find that when I'm evaluating my results that, I trade dollar yen really poorly in the past couple of weeks. Maybe I should stop trading it for a while. Or maybe my strategy doesn't work. I find that my strategy doesn't work on dollar yen as well as it may on the Aussie dollar, for example. So it's only through this self-review analysis that you can, identify some of these pitfalls that you may be doing. And then lastly, have realistic expectations. How do real money managers perform? Top money managers risk no more than 5% of their equity, and they just aim to beat the S&P or the index average. So if that's what professionals do, how much can you really anticipate that you make every month, day, or year? This is the Barclays Currency Traders Index, and you can see between 1987 and 2017, or even in the last 10 years, the best return is 4.6% for 58 currency professional hedge funds that are included in this index. Of course, and usually sometimes they only make 1%. Their losses are also very small. In the best year, they made 57%, but I bet you at the time there were very few funds. And generally speaking, the best is 11%. So if that's what these professionals are doing, how much can you expect to make from currency trading? These are unlevered, of course, or very little lever, but you really, if you want to stay and survive in this market, you want to make sure that you basically, don't have unrealistic expectations where you can't meet these returns. So let's get down to business. We all want to I recommend that you approach trading like a business. You have a trading plan. Your trading plan is your business plan. If you don't write it down, you won't do it. So, make sure that, that you write down your trading plan. And you think about, what you're planning to do every single day before you actually start to do it. So 3 questions that you should ask with every trade that you take. Number 1, what is my reason for the trade? What is the entry strategy? How much am I looking to make? What is my exit strategy? How much am I willing to lose? And don't believe what you're taught. You want to make sure you test everything that you learn before you take the trade. So now it's time to get down and dirty. And I'm beginning to run out of time, so I'm going to run through these quickly, and they're very quick slides, so you won't be missing out on anything. How do we find trading ideas? We find trading ideas by watching, because speculation is the art of observation. And we observe, and in an observation, we find the rhymes of the currency market. But in order to truly understand the currency market, we have to trade. And we have to trade because there's no substitute for practice. Professional golfers will, will basically be at the driving ranges practicing their swings. Jugglers will also be practicing their talent. So there's no substitute for live practice. So we'll only really learn to trade when we trade live and not demo, because there's very significant benefits to trading live that you don't have with demo. The most important of which is that you're trading under live market conditions, and when you trade under live market conditions, you add the psychological element to trading, which is very, very important. And it helps you understand the strategy much better, because the real value of the strategy is not whether it works, but whether you actually use it. And it is through this observation that we're able to develop some of these strategies. So just to share with you how we came up with one of the strategies that I shared with you today, or how we broke it down and came up with some of the trading rules. Here's anatomy of how I designed the extreme fade strategy. Observation number one. First, we watched the markets. We had an observation that extreme moves rarely continue without any pullbacks. So initially, I just used the Bollinger Bands to help me identify these overbought, oversold signals. But then what I realized is that there was a lot of noise in that. So I added the ADX filter in order to eliminate the noise. And so I was trading that for a while. And I was actually trading that, you're trying to go for the ideal 2-to-1 risk reward. But what I found is that even money actually led to a losing edge, because with day trading, the more you trade, the more you realize that there's a lot of give and take in the markets. And oftentimes with day trading, you can't expect to get, and it's actually unrealistic to get the perfect, in order to have a decent risk reward, a decent stop, which in day trading has to be at least 20 pips. You have to go for 40 pips, and you just cannot get 40 pips in day trading. That's more, for swing trading. So we realized that even money resulted in losing edge. So our initial experiments used wider stops and targets, but what we realized that our targets were often missed, sometimes just by a little bit. So narrowing the targets helped to increase our win ratio, and setting initially negative risk-reward parameters resulted in a positive edge for our strategy. Also, with extreme fade, we realized that majors work best because after trading it for a while and through, reviews of our strategy, and also through some self-reflection, because pairs like pound yen tend to trend a lot more than a pair like Aussie dollar or even dollar yen. So we focused on trading euro dollar, dollar yen, Aussie dollar, Kiwi dollar, and that definitely improved our results. And the last observation that we have is that running big events was dangerous. You definitely do not want to be trading these short-term strategies ahead of big news events, because that could change the technical structure significantly. And oftentimes you're getting these extreme fades before a news event because people are just pre-positioning. The best times oftentimes to trade these strategies as after the events. So staying out of the market lowered the volatility of our strategy, strategies, and actually ended up giving us much better results. So what did extreme fade teach me? It pays to wait for confirmation. We want to be selective with what we trade. And Warren Buffett was right. In trading, you don't win by winning, you win by not losing. So that's why if we only get our 10 pips with day trading, we take it and we move on. And that's the way you want to think. So in summary, the steps to successful strategy development involves trading live, defining your initial rules, refining them on charts, test logically in Excel or some coded back testing. So you can pay someone to code if you want, and always examine the results that you get. Never trust the machine. Understand, review the results to make sure they look right to you. Understand failure, refine again, trade live again, and reassess every 6 months to make sure that your strategy is working the way it should. So I want to leave you with the top 5 mistakes that FX traders make. And their stops too small, targets are too wide. And targets are too wide is a mistake that we have made for many years before we finally realized it. Trade too large and swing for the fences, and you can, if you live too large, you can sink very hard as well. Despair in the face of failure. Sometimes, you may have a couple of losing trades. You may get your confidence may fall a lot, but, you may look at this. Is this a losing strategy? It may seem like it is to you, but if you have a strategy that does focus on, just catching a couple of big winners, here's the strategy in full. You don't want to just look at a strategy in a small vacuum. You want to make sure you look for at least 10 to 20 trades before you evaluate whether it works or not. the biggest mistake of them all is the failure to use a stop. And that's how some of the geniuses fail with the global macro trades. So the biggest mistake of them all is just trying to keep on buying when it's moving against you and not using a stop. And the last one is trading because of boredom or anger. You want to have a strategy, trade a strategy, and that's what you want to focus on. So with that, I'd like to open the floor up to any questions. I hope you enjoyed this presentation.
Thank you, Kathy. That's been fantastic. I've got only a few questions here. A lot of them can be answered by going back through the slides and the replays. So going to your risk-reward ratios, you mentioned that the negative risk-to-reward ratios tend to give the best result. Did you have a set sort of negative risk-to-reward ratio? Was it 2 to 1 on the negative side, 3 to 1? What was the one that you found to be best?
For me, I think the 10 pip target for day trading, 20 pip stop works the best. And this is primarily the thought process you want to use for day trading. For swing trading, because you're going for more pips, you could have better risk reward. But for day trading, definitely I like 10 pip target, 20 pip stop.
Okay, great, thank you. And in terms of the smaller 10 pip trades, how do you factor in obviously the cost of the trade in terms of commissions and larger spreads?
Well, you only get the larger spreads with the crosses, right? So with day trading, in our experience, it's best done with the majors where the spreads are much tighter and it's much less of an issue. And it only really becomes an issue with the crosses, in my opinion. So I really never have this problem. Sometimes pound may be a little bit more volatile, so maybe you want to do a 25 pip stop, but the rest of them I think are quite orderly.
Okay, great, thank you. And in terms of an average trade, how many confirmations would you look for in terms of, looking for an ADX or a simple moving average? Would you look for a minimum of 2 or 3 or 4?
Well, if you're talking about how many confirmations for a strategy, meaning if you're scrolling back in your charts, I mean, generally speaking, if you're looking at examples, you want to find at least 7 positive examples out of 10.
Okay, great, thank you. And in terms of your swing trading, so obviously the larger trades, what was the ideal target in the pips for that one?
So with the swing trades, the ideal is probably about 70 pips in my opinion. But we share, in our previous presentation, we shared swing trading strategies which have specific entries and exits. So you can review that, or we can bring back swing trading next time I talk. But those would be good places to reference.
Awesome, thank you very much, Kathy. That seems to be the end of the questions. The majority of the rest of them can be answered just by the replay. So really appreciate that, and yeah, we can finish it there.
Thank you so much for having me. Once again, I really hope you enjoyed this presentation and have a great evening.